All right, let's get right into it. The Federal Reserve is about to make a huge decision on interest rates. And believe me, this is the kind of thing that's going to send ripples through the entire stock market. It's a massive moment for every single one of us as investors.
And I'm not exaggerating here. Professor G from Investing Simplified said it perfectly. He said this one decision, it could set the tone for the market for a full decade. So yeah, the stakes, they are incredibly high.
So that all leads to the big question, right? The one we all care about. What does this actually mean for your portfolio? Well, that's exactly what we're going to break down. We're going to look at the two most likely scenarios and give you a solid game plan for what to do next, no matter what happens. Okay, so to really get what's going on here, you first have to understand the corner the Fed has painted itself into. It all boils down to this really tricky balancing act they have to perform between two goals that are constantly fighting each other. It's what they call the dual mandate. Basically, Congress gave the Fed one job with two parts, and it's a tough one. They have to keep prices stable, low inflation, and make sure people have jobs, so low unemployment. The huge problem, these two things, they're like a tug of war. They pull in completely opposite directions. And this chart just lays out the dilemma perfectly. Want to fight inflation? You got to raise interest rates. But that cools down the economy, which can mean, people losing their jobs. On the flip side, if you want to get more people working, you lower rates. That makes money cheap to borrow, but it can make prices go haywire. So you see, the Fed is constantly walking this incredibly fine tightrope. So where are we right now? Well, inflation is sitting at about 3%. Now, that might not sound like a lot, but it's still a whole point higher than the Fed's 2% target. And that's exactly why they're hinting that they're going to hit pause on cutting rates, at least for now. And this decision point creates two very, very different futures for the market.
All right, let's walk through scenario number one. What if the Fed just keeps rates high? They just hold steady for a while. Well, in that world, there's a saying that just sums it all up. Cash becomes king.
And the logic behind this is actually pretty simple but really powerful. Think about it. When it's expensive to borrow money, who wins? The companies that are already swimming in cash, right? The ones that don't need to take on debt to grow. They get a huge leg up. And these are usually those steady, defensive companies, the ones we all rely on, good times or bad. And here are a couple of great examples of what I'm talking about. Look at Katera Energy. It's spitting out a free cash flow yield of 7.4%. In a world where money's expensive, that is a very healthy sign. And then you've got Skyward Specialty Insurance with a whopping 18.2% yield. I mean, wow. Insurance companies, they can do really well when rates are high because they earn more on all the cash they're holding. These are exactly the kind of cash-generating machines Wall Street falls in love with when debt gets pricey. Okay, but what about the flip side? Let's talk scenario 2. What happens if the Fed does a 180 and starts cutting rates? Well, if that happens, get ready, because that's when growth stocks, especially in tech and AI, could just absolutely take off like a rocket. And here's why. It's a little bit of financial math, but it's super important. Lower interest rates actually make a company's future profits worth more today. And since growth stocks are all about those massive potential paydays way down the line, well, cutting rates is like pouring rocket fuel on their stock prices. So, who are the big players in this scenario? Well, you're looking at them. You've got Broadcom, which is absolutely crucial for the guts of AI infrastructure. Then, of course, the big one, NVIDIA, the undisputed king of AI chips. And a company like Snowflake, a cloud business whose entire stock price is built on the promise of massive future growth. For all of these guys, a rate cut wouldn't just be good news, it would be a huge tailwind pushing them forward. Okay, so we've got two completely different possible futures, right? Rates stay high, or rates go down. So how on earth are you supposed to invest when you don't know which way the wind is going to blow? The answer is you don't pick a side. You build a portfolio that's ready for anything. Look, let's be real. Trying to pick that one single stock that's going to be a huge winner, it's incredibly hard. I mean, even the professionals get it wrong all the time. That's why for most of us, there's a much, much smarter way to go. Diversified ETFs, exchange-traded funds. It's simple. They let you own a tiny piece of a bunch of different companies, so you're not putting all your eggs in one basket. So, if you're preparing for that rate-stay-high world, value ETFs are a fantastic tool. Here, we're comparing two of the big ones, SCHD and VTV. Think of it this way.
If you want your portfolio to pay you an income, SCHD is a beast with a dividend around 4%. But if you're more interested in seeing the stock price itself go up, VTV might be more your speed. It's packed with giants like Berkshire Hathaway and has a great track record. And then for the rates fall scenario, you do the opposite. You look at broad growth ETFs. This is how you get exposure to all those exciting high-flying names like Nvidia and Tesla. But, and this is the important part, you're doing it with a safety net. Since you own a whole basket of them, if one company has a rough quarter, it doesn't sink your whole portfolio. It's really the best of both worlds. You get to be part of the growth, but with way less risk.
Now, of course, ETFs aren't the only game in town. Maybe you're the kind of person who just loves digging in and doing your own research. If that's you, there are some amazing tools out there that can seriously help. You can think of it as a simple 3-step process. First, you could use a tool like ProPix AI to find some AI-curated stock ideas to even get you started. From there, you could jump over to a conversational tool, something like Warren AI, to ask really specific questions about a company. And finally, if you really want to go deep, you can get your hands on the same kind of data the hedge funds use with ProPlus. It's a fantastic way to really build your own confidence in an investment and maybe even spot a few hidden gems. And all of this brings us back to that one final, really important question. I want you to look at these two completely different futures we've talked about and just ask yourself, is my portfolio actually ready for either one? Because at the end of the day, whether rates stay put or they get cut, the key is having a balanced strategy, a mix of that steady value and that exciting growth. That way you're not just crossing your fingers and hoping for one outcome. You're prepared for whatever the Fed throws at us next.